Joining us from Sydney is Michael McCarthy. He's Chief Market Strategist at CMC Markets. So, Michael, you're saying that the markets are pricing in an extreme scenario. How extreme? Describe that for us.
Well, Lindsay, we look at markets from the top down and the bottom up, and it's that bottom up valuation in share markets that's really starting to concern us. We're seeing growth in earnings across the Asian region of between 8 and 13%. In the US, we're looking at projected earnings growth of 14%, and even in Europe, we're looking at projected earnings growth of around 7%. And yet the market index levels are actually forecasting, or to bring them back in line with their long-run ratios, would be suggesting that we're looking at, over the next 12 months, a fall of 20% in earnings. So when we look at companies from the bottom up, the investment case is very solid. When we look at the markets from the top down, they're suggesting that not only is the world about to move into recession, but it's going to move solidly into recession. And at some stage, this disconnect between the numbers we're seeing at the company level and the pricing of the markets overall has to be resolved.
When is that stage, and how do you position yourself to take advantage?
Well, it depends very much on your outlook. For our trading customers, we're recommending a highly disciplined approach in these volatile markets. But for investors with a viewpoint of 12 months or more, now is the time to start considering equities. The risk-reward ratios are starting to become compelling. And even if we do, in fact, one of the best things we could see in the current situation is a Greek default, so that we could actually put the numbers on the table, see what the results are, and move on from the situation. While we linger in this political sphere, it's that uncertainty that's creating this extreme pricing of risk, and until that clears, we could see continued depressed levels. But on a 12-month view, those compelling valuations we're seeing across the board in equity markets, and combined with the fact that we're seeing record levels of cash, both at the individual level and at the fund management level, mean that the risk-reward case for equities is now stronger than it's been for some time.
What sectors, what countries, what kind of equities are you looking at?
Well, one of the ones that stands out to me is the Chinese-exposed Hong Kong banks. They're trading on PEs of less than 5. In fact, some of them touched 4 in today's trading. That's now starting to become compelling. And unless you're looking at an absolute rout in property development markets, for example, this is a compelling case for investors. Finance companies around the globe have been marked down very solidly on the idea that we could see a credit freeze like we did in 2008. Even if we do get defaults in Europe, the chances of the credit markets freezing again are very low. And so while we're pricing that extreme risk scenario, I think the finance sectors are compelling. I'm also looking at the moment at the Macau casinos. The cash flows that are coming through there and the evidence on the ground of high customer participation suggests that once again the markets are not pricing the risk there correctly.
All right. Thanks very much, Michael McCarthy, CMC Markets Chief Market Strategist. Thanks very much.